Third quarter earnings season is upon us, and the expectations aren't pretty. Our next guest out with the call, he says the quarter will end up being negative, or if the normal surprise trend plays out, we could end up with flat to slightly positive numbers. That's according to Mike Thompson. He's managing director at Goldman Sachs Asset Management. And Mike, the numbers on this, you're looking for earnings decline of about 4.1%.
Indeed, and this would be potentially the first and possibly last quarter of negative growth as we get out of the really tough comp period as a function of that tax reform bill. So yes, right now the consensus is around negative 4.1. We've been seeing about a 3 to 4% surprise. I think your best opportunity to get that deficit up would be the technology sector, which is currently, the read on that from the market is about down 8.5%.
For earnings.
Yeah, that's right.
You know, I feel like I've heard this story several times over the last many quarters. We keep thinking it's going to be an earnings recession, and then it turns out that companies have underpromised and overdelivered. Do you think that's going to be the case this time, too?
I don't see why it would be different. Honestly, I think there's been a lot of hand-wringing. And the other thing, here's a little bit of good news, is that as we move away from, again, that 2018, where we had the inflated earnings because of all that extra cash that companies got from tax reform. And then 19, it really stole a lot of that earnings potential right there because the comps went higher. I think you now get to see a better picture of what earnings are, and they look better. They look better, presuming that you continue to avoid a recession and you have even inexorably slow growth. Expectations next quarter are already over 3%, and then it even gets better, 7%, and then 8% for the following two quarters. So the second quarter of 2020, we're looking at an 8% expectation for earnings growth.
Although that's such a long way out, and there's so many things that could change things between here and now. I mean, just the China trade talks could have a huge impact on what any of these companies are reporting a month from now, let alone 6 months or a year from now.
Absolutely. I mean, I think the one interesting thing is that if you listen to the narrative from the market, and at Goldman Sachs Asset Management, we're considering a lot of this stuff, but you do concern yourself about kind of the impact on trade, the trade issues and the notion of a global slowing. That would have an impact. But if we avoid recession and there's enough economic strength, we think that these earnings continue to kind of move forward. And let me just kind of break this up. Let's think about the S&P. The S&P has the ability to generate earnings not just from basically the businesses. They have the ability to buy back shares. And in fact, that's what they're doing. Do you know, I was actually looking at an S&P report, and every quarter they add 0.7% of earnings growth just by virtue of buyback. So on an annualized basis, you're getting 2.8% annually in buyback yield. Add that to the 1.9 that you get from the dividend yield, you're at 4.76 starting.
So the headline is, okay, we're looking for negative numbers, but maybe don't believe the hype just yet.
I think the numbers might be actually not all that bad.
Mike, thank you. It's great to see you.
Good to see you.